Hi, my name is George Dagnino. I'm the editor of the pptx portfolio. Things have changed, and this is why I sort of was late with this video. I think things are changing for the better, but the changes are very subtle. So let me go through some of my data, and I will talk to you about the business cycle, the new durable goods orders, what they're telling us about the consumers' income and spending, very important data. Then what's the status of the employment reports, openings and quits. Housing starts is so important to determine what is going to be the rate of inflation. And and then there's some surprising data about unit labor costs and their impact on inflation. How is really the economy responding, which is how commodities are doing and interest rates are performing. That tells you really what the markets are reacting to all this. And then I will have a view of what the stock market is doing and what is the financial risk. And of course, then I will show you some stock performance that we are of our recommendations. So let's go. This is our model, and in phase one of the business cycle is when the business starts rolling and things start improving. Phase two is when things get hot, growth is above average, and towards the end of phase two, then what you have here is interest rates, inflation are beginning to rise. Commodities, of course, have been rising for a while. And of course, at the beginning of the phase three, this is when profits start slowing down and because of rising costs and rising wages, inflation, and so on. Phase four is the critical one. This is when all the constraints to growth, which have been a rising inflation, interest rates, commodities, and everything else, eventually has to be corrected. Only when, if, and that's the crucial phase of the business cycle. Only when all those trends are coming down decisively, then consumers' purchasing power improves. At that point, at the end of phase four, inventories are in line with sales. Growth of production is about equal to the growth in sales. So as soon as consumers feel a little better, they start buying, and of course, business is ready to go and increase production because inventories are already too low. So the purpose of the following slides is where we are we. And it looks like there are many things happening in phase four, and typical of phase four. So but I'd like to go into the details and see where we're going from here because it's important from an investment strategy viewpoint. This is an important information because orders are big ticket items and spending on big ticket items. In other words, if the first thing that business and consumers cut when they are under stress, and by the way, they're under stress because since the last 3 years, purchasing power has increased anywhere between 30% and 40%. So people are making considerably less money in the last 3 years. So what you see now is durable goods orders, which is this one, the blue line, and consumer spending, really have been flat to down for the last 2 years. Why? Again, because they cannot spend. The first thing that the consumers cut is car buying, or otherwise furniture, or otherwise refrigerators. So this is where you can see that consumers are under stress. And that is fine. This is where most analysts focus and say the economy is in recession, consumers are in bad shape. But wait a minute. Before you reach that conclusion, you have to look at this data. And what it shows, this is, by the way, is all the data that I show are after inflation, so in real terms. And what you see here is something very, very important. Income and spending are increasing at around 2%, which is very good growth, very solid growth. And why is income and spending? It's caused mostly by the enormous, outrageous amount of money spent by the government. And so far, things looks good because, again, consumers are making money and they're spending it. And this is positive. This is what people don't realize, but this is the underlying strength of the U.S. economy. We saw that consumers are still making money, but they're not spending it on big ticket items. Why? Well, the job situation is not that positive. Actually, it's just lukewarm at best. As you can see on this chart, openings and quits are declining. Opening means that there are fewer jobs available, and quits means people are not quitting because they don't have an alternative to go to. And why is that important? Because when you have a decline of this magnitude, like in this period and like here, you have a gray line, and the gray vertical line means a recession. So this means this weakness in openings and quits means there is an underlying weakness in the economy. Another important leading indicator of the economy is housing starts. And housing starts, as you can see, they decline ahead of a recession. And here they have been declining. People cannot afford houses at current prices. Now, two things have to happen, and I wrote about it in this issue of the Peter Dack portfolio. Two things have to happen: either prices come down, or houses have to come much smaller from the Mac mansion that we have been using. So that probably is what is going to happen. Prices come down, but also the sizes of new homes will have to decline. This is an important chart about inflation. First of all, as I showed in other videos, the decline in inflation is followed by a decline in the growth of the money supply after a year and a half, roughly. But I would like you to focus on is on the dark line. The dark line is the growth in home prices. They lead overall inflation. So the fact that home prices are slowing down, they're still increasing, but at a slower pace. Actually, the last month have been growing almost zero. That means inflation will decline. This is very good news. And as you can see here in the details, there are producer prices and consumer prices. They're all declining. The odds are the inflation is going to decline. This is a very important trend because this is what happens exactly in phase one. In phase four. That's the purpose of phase four, is to slow down the economy enough to bring down commodities, interest rates, and inflation. Now you see inflation coming down. This is good news. Why? Because after phase four, there is phase one, and phase one is where really you make money. This is something people don't talk about it because, they're getting to something that is not common knowledge. However, the blue line coming down, the red line is productivity, and the blue line is unit labor cost. Productivity means how much we make per hour. The more we make per hour, the more wealth we create. So this is good. But what happens is that then when we make more for the same amount or for lower amount of time, then your labor cost gets spread out on more and more goods that you produce. So the cost per item is slowing down. And this is what is happening. Labor cost per unit of output, per unit of a gadget that we produce is coming down sharply. This is extremely good news because that means that companies' profitability is like to be maintained. And this, of course, is good news for stock prices. I know people don't talk about it, but this to me is one of the most important trends that has been developing, together with declining inflation and rising income and spending. Well, let's see now how the interest rates are behaving. Well, of course, interest rates have been coming down for a while, months and months ago, well before the easing of the Fed. This is the 10-year and this is the 2-year. Yes, interest rates have come down quite a bit, actually, since mid of this year, early this year, both on the 2-year and the long term. And this is exactly what you expect in phase 4. The economy slows down, inflation comes down, interest rates come down. So the stage is being set for phase 1. This is what I'm trying to drive home. These are data, it's not opinions. This chart says that there is a lot of money around. These are the spreads between different grades of bonds and treasuries. And when the spread is small, means that bank bonds of corporations are not risky, and therefore, why? Because there is a lot of liquidity, which makes risk very low. So the fact that the spreads are coming down and they're flat, a very low level, it tells you there is a lot of liquidity, which is good news for everything, especially financial assets. And I'm referring that to stocks. This is another great trend. People are so worried about negative news that when there are good news, people don't talk about them. This is the percent of banks tightening credit standards. So when the majority of banks tight lending standards means that they don't want to give you the money if you want it. So they increase the cost of money to the point that you say, no, I don't want to borrow anymore. And what happens, as you can see happens here, when they don't lend, then what happens? People don't borrow and the economy doesn't go anywhere and you see a recession like it happened here. But then what happens? The less banks are tightening, so more banks are easing lending standards. So when the curve declines, means the banks are easing lending standards. They want you to lend money, and this is good news. This is when you see the end of a recession, you see a strong bull market, and you see a strong economy, not strong, but a growing economy in the 2-3% range on average. So this is good news. Look at what's happening right now. Yes, before 2022, they were tightening because they were concerned about what was going on. But look what has been happening in the next 2 or 3 quarters. Banks have been easing lending standards. Why do they ease lending standards? Because there is a lot of liquidity around. They want money. They see some light at the end of the tunnel. Besides, now the Fed is lowering interest rates, so they make even more money on the spread between short-term and long-term rates. So this is good news. This is very good news. Banks are easing lending standards. Interest rates are declining. Inflation is declining. So you see the things that are happening in phase 4, or the business cycles are really taking place. This is another very important chart. I know I'm saying this for every data, I know that. Anyway, but this is particularly important because it's the money supply. It's a very leading indicator of economy, inflation, and everything else. And as you remember, the inflation peaked a year and a half after the peak in the money supply. The money supply now has been rising, and this is very good news. Supports the idea that there is a liquidity in the system, and that's why banks are easing lending standards. That's why the stock market is strong. That's why, and so on and so on. However, now bank deposits is the brown line, and what it's saying is that business is putting money in the banks. Why? Obviously because they're doing well and they're making money. So what happens? Banks get this money and they relend it. And by relending it, they create money. They print money. They create liquidity. And that's why the money supply is improving. That's the good news. What I'm looking at is a turning point, as I said, in the money supply, leads by a year and a half, a turning points in inflation and interest rates. And the money supply peaked in 2022 roughly. So if you put another couple of years, you get, now we should 24, end of 24, 25. Yes, inflation should come down, but at some point we should have the effect of this increasing in liquidity on inflation. It's not happening, but I'm telling you this so that you know what I'm looking at. Why I'm looking to the possibility, not now, not in the next 2, 3, 4 months, but there is something now in motion. This chart shows the S&P 500 in our proprietary business cycle indicator. Now, what is the meaning of that? Well, what is this? The business cycle saying that when you reach this level here, chances are you have a period of not necessarily declining in stock market, but you see a period of transition from cyclical to more defensive, from cyclical to more defensive. Now this is now getting very close to the blue line, and this is an important position. So what it's saying is, yes, the market has been going up. Yes, cyclicals have been strong, but beginning around this time, and I show this in several articles and other videos, the defensive stocks have been performing well. The defensive outperforming the cyclical. This is usually, this level shows when the market is ready really to boom. So we are getting almost there. Given the liquidity that I showed you before, the bond spreads, money supply, the important easing of the banks, stocks don't decline during such times. So of everything, they start trading in a narrow range. So the structure of the market, the amount of liquidity in the system is that stocks may be a little volatile ahead of election, but the odds favor higher price ahead. As we mentioned in our report, the pptx portfolio, in our videos, we realized that with the business cycle indicator turning down, the market would have been more volatile, more uncertainty. So what we decided to do for some time is to start investing in a very near term. It could be anywhere between a week to 3, 4, 5, 6 weeks. What has been the outcome of this, our recommendations? I will show it to you, obviously, because they're doing very well. So we have a 75% plus gain to loss ratio, and we have more than 71% batting average. In other words, the majority, 71% of our recommendations are profitable. And this is the bubble chart of our transactions since the beginning of the year. By the way, this data, we have a model portfolio in our service, and is with Schwab, and Schwab is providing us this data. We have the pptx Business Cycle Academy on www.patreon.com/pptx, and there are 3 levels of membership. One, only videos. The second level is membership videos, plus every time there is an important economic release, we provide an analysis implications for the market. And then there is membership number 3, which our members receive the pptx portfolio, which is 22 pages twice per month, plus the videos and the economic and financial updates. Of course, if you are not a member of the pptx Business Cycle Academy, we would love to have you as one. And we thank you very much for watching. Again, if you found this content valuable, you just can go to www.patreon.com/pptx and find a lot of information, analysis, reports, videos. And of course, our support will help us to produce more data for you and more research. Again, we thank you very, very much for following us and for watching this video. Please do keep in touch. Have a wonderful day. So long.